It's September week 3. We are already at monthly OPEX. And we also, this time around, will have the ES contract expiring as well on Friday's open this week. We are trading the December ES contract. That's the front month contract now because we had rollover day on Friday, Thursday night when futures reopened for the overnight trade. December became the front month contract. Very different spread now. It was 10, sometimes even 11, 12 points of spread between what the S&P was trading at and what that ES contract was trading at. Anyway, let's focus though first on some past pullbacks because clearly we are in one right now. We are about 2% off the all-time high using the low that we made on Friday so far. But let's take a look at the last couple of the last big pullback that we saw in the market. We have to go all the way back to the end of 2020 as we were heading into the presidential election in November. That's what this cross-section of the S&P 500 daily chart is from. Over on the left side of the screen, you can see towards the end of July, beginning of August, we kind of catapulted into this big rally. There was a huge gap up, in fact, between August 21st and August 24th, and that kind of gave us this sort of blow-off top experience, ending in an all-time high at 35.88 on September 2nd. We hit our current all-time high, I believe it was also exactly on September 2nd as well, and just shy of 1,000 points higher than that. We were at 45.45 with our all-time high in 2021, and it was 35.88 on September 2nd in 2020. And from there, we rolled over and sold off until we had pulled back a full 10%. And this pullback was a combination of that big percentage level. It was a move against the 2019 close. This was the level that left us 2020 positive or negative. And this was a very sore spot for us earlier in the year when we were selling off over the COVID, when we were seeing the big COVID sell-off at the beginning of 2020. So this was a really important level here. This was where institutions clearly stepped in and saved us from ruin. And the 100-day simple moving average was here. So it was a combination of three factors that made it attractive for somebody to come in and start to turn this thing around. Well, we rallied back up, but we made a lower high against the one in September. Plus, we had the uncertainty of the election coming up. So we rolled over and sold off again. But this time we held that low, that 2019 close. We held a higher low against here, this 10% pullback. And even though we broke the 100-day simple moving average, I think holding that low, holding a higher low against here and not breaking this 2019 close, not allowing things to go negative on the year, was proof that it was the same buyers and maybe they were just doubling up their position. Maybe they started their position here and added the rest of it here, because from here on out, we have never seen a pullback this deep. And here we are a full year later, and we've not seen anything like this so far in 2021. So let's talk about that. In 2021, here have been our major pullbacks. We had a little pullback here as well at the end of January, beginning of February, but our biggest pullback this entire year was this one here. We topped off at a new all-time high at, what's that? Yeah, at 39.50 around the middle of February, and sold off to the beginning of March to about a little over 200 points, about a 6%, a 6% pullback. And if we take this range that was traded, draw a box around it and lay it down over the next pullbacks that have happened throughout the course of the year, I mean, you can visually see that there's no way that this first one in January was as deep as this one. This next one here around the beginning of April, around the beginning of May and lasting through the end of May, nowhere near as deep. Certainly not in the one in July. This one here in the middle of August, I'm not even drawing a box around because that was a joke. And here we are now. If we put a box down on the range that we've traded, we're not even like halfway there. And if this was if we were to duplicate this range of the pullback that we made here at the beginning of the year, we would sell off down to about the 100-day simple moving average, which is similar to what we saw at the end of 2020, and we would need to hold at our 15% mark on the year, our plus 15% mark. And you can see there was a lot of hand wringing and a big pullback that was going on in here back in July, that it revolved around this mark, this 43.19 to 43.20 area. So maybe what we're looking at here is maybe a more drawn out, longer version of what we saw at the end of 2020. Maybe we need to come down here and pull back and hold a higher low against this one that was made here in July, test the 100-day, test this 15% mark. If we go by percentages and duplicate a 6% pullback like we saw here, we'd need to come down to about 42.75. If that was the case, what we would be doing is, definitely testing this low here from July. But maybe this is where we've got to go before we find the interested buyers who want to get on board and take us through the rest of the year. So that's food for thought for you. There's one other thing I wanted to point out to you within the workings of this pullback that's going to be really helpful now. As this pullback started, you can see here was a break of the 10-day simple moving average, and it closed below it on the very first day of the pullback. The next day, the bounce failed to retake the 10-day, and we sold off below the 20-day, and we tried to regain it on the close, but we just closed just a slight bit under it, and that motivated sellers to come in for several more days. And you can see how all the bounces failed against the 20-day simple moving average before they just all gave up, and we sold off again, doubling down the range all the way down to the 10% mark and this big low that was made. And it all came from this stuff going on here, these failures at the 20-day simple moving average. And you can see when this first bounce began to work, there was a big gap up open in here to get back above the 20-day. And then on the way down, once again, that break of the 20-day caused us to liquidate, and you really didn't feel safe being long until you saw this day here, where we took out the 20-day and closed above it. And from there, boom, on up we went. So let's keep an eye on this 20-day. That's a very important level of support and resistance for us right now. Looking at this move on Friday that we just lived through, this is the intraday chart, and I marked on here where the 10-day simple moving average was when, in the morning when we opened and traded up to it and failed with a look above and fail at the 10-day. Our high on the day was only 45.20. Our bounces all for about the last week and a half have been failing at 45.30. Seems that call sellers ratcheted it down another 10 points and we're blocking the doors at 45.20 instead this time because we failed there. And you can see here was where the 20-day simple moving average was, and we failed it. We were sitting below it, rose back above it finally around noon Eastern time, but really could not clear and get back above 4,500, the 4,500 mark. And this is where I looked at the 4,500 calls and I said, well, look at all the volume that's there. We had already traded over 10,000 of them by this point in the day. And I said, if those were call sellers, we're not going to make it above 4,500 the rest of the day. And sure enough, and I'm talking about the monthly 4,500 calls. And sure enough, we sold off, broke that 20-day simple moving average, and boom, liquidated down, made it all the way through to our 44.60 80 handle rule level. In fact, dipped into the 44.5Xs, the 50s. So the next thing lower below us is this gap, and this big gap from the end of August. If either we're going to hold 44.50 and reverse and get back above this 20-day and try to rally on back above 45.20 and 45.30, or we're going to fill this gap and fail it and keep on moving lower and continue this sell-off for a few more days. So, but the big thing is that if no matter where it is that we bounce, the bounce must regain the 20-day simple moving average and hold it on a closing basis. Otherwise, I just showed you what happens when you don't obey that line as a rule. And here we are on the roadmap. And you can see here's our daily candle from Friday, pretty much a double down on the day, maybe even a little bit more than a double down on the day from loss of the 20-day simple moving average. And at our low, we were just about at the 2% off mark on the year. That's about 44.55. And if we're going to head just a little lower, maybe all we need to do is maybe look into this gap a little bit here. Maybe look below 44.50, or maybe we hold above 44.50, hold above this gap, hold above the August halfway back at 44.52. There's a lot of traffic here at these 44.50s. Maybe we're going to just make a little lower low, reverse, and move back up. But if we move back up, we got to retake and close Monday above the 20-day. Otherwise, we're going to see more selling on Tuesday. That is a big line in the sand, something to obey. And then let's look at the volume real quick on the options. Here are those September 4,500 calls. You can see that volume doubled as the day went on. When I pointed them out earlier in the day, they were at about 10,000. They ended the day with almost 20,000 in volume on a 31,000 open interest. By the way the price action went, I would say it was call sellers that were creating this volume, but it was a combination of call sellers and people just getting out of their calls because there is a lot of open interest there, and it is a monthly option. Over on the put side, you know, you're already getting priced out of the market here. I mean, most people are not going to be willing to pay. I know most of you don't even want to pay $8, an $8 window price for an option, much less listening to me and tell you that, well, you could pay $16 for a put, and if you usually buy 2 of them when they're the $8 window, you just buy 1. So think of it that way. Well, if you can't even stomach paying $800, between $800 and $900 for an option and risking that, then, you know, there's not going to be any trading for you of the S&P 500 with these kind of prices. Maybe you want to look at SPY, but use the S&P 500 as your analysis, as your point of analysis. Don't analyze off of a SPY chart. That's my opinion, and that's what you have me for, is to help you with that. But anyway, you're going to have to think in terms of that, where you usually pay the $5 window, be willing to pay the $11 window in a half-size position. Where you usually pay the $8 window, be willing to pay $16 and a half-size position, and so on and so forth. Okay, that's it. I hope this video helped you out. I hope you understand and totally are on board with this idea about this 20-day simple moving average, and I hope that a historical view back to the stuff that happened in 2020 was helpful. Have a great rest of your Sunday. As always, good luck and good trading.